So I'm going to tackle Sandstorm Gold, symbol SSL on the TSX. Its stock price is 548, $1.63 billion market cap, 1.42% yield. What does Sandstorm do? Well, they are a precious metal and streaming company, a royalty company as well, offering investors leverage to gold, low operational risk, strong margins, and exploration upside. Now, the questions surrounded the strong gold pricing environment over the past year and Sandstorm's price over that time in terms of what the stock has done. Well, gold was up almost 12% over this past year. So a good, strong gold pricing environment. What did Sandstorm do? Sandstorm over the past year was down roughly 18%. So what gives here? Now, we do know the junior exploration and mining market has had a tough past 12 to 18 months with higher interest rates. Financing has been harder to come by, and the equity in markets have been not so good for them as well. The financing really dried up in 2023. This should, to a degree, play into the hands of a royalty or streaming financing company who offer a different method when other methods seem more pricey. But it certainly hasn't helped Sandstorm stock. The market, again, can get things really wrong in the near term. So let's take a look at what is playing out here. Let's look at the recent numbers, the annual numbers reported by Sandstorm, see if they tell us a little bit of the story here. Well, you can see revenues were up significantly, over 20%. EBITDA was up 36%, so strong growth there. But if we look at cash flow on a per share basis, this is an adjusted cash flow figure, it was actually down almost 5% over the past year. Well, there is something at play here, a couple of things at play here. One of them would be Sandstorm's share count. As we can see, over the past several years, particularly in 2022, there was a jump up. Again, this is an investment for additional growth going forward, but it's a significantly higher share count today than it was a year to 24 months ago. And that plays into why you see a lower per share cash flow. It's good to have that revenue growth. It's good to have adjusted EBITDA growth. There is per share, but there is not per share cash flow growth here. We also see, and I'll talk about this in a second, significantly higher interest expense. Let's look at some other highlights from this company over the past year. Record attributable gold equivalency ounces produced, you can see there. Again, record revenue, and we saw that. There's record cash flow from operations, but the per share cash flow on an adjusted basis, the free cash flow was not higher. Again, and net income was actually down over the past year. So let's look at valuations. Are they extremely attractive right now? Well, SSL trades with a trailing PE of 47, enterprise valued EBITDA of 13.3, and a price to adjusted cash flow of 12.6. Now, I would say these numbers may move higher over the next year, all things in terms of share price staying equal, given lower expectations for EBITDA and cash flow. So our conclusion here, the company has taken on significant debt to invest for future growth, and that debt is becoming more costly. If we look at interest expense jumping just over the past year to $39.4 million from $17.2, that's more than double. While growth should be coming from these investments over the next several years, it is not here today on a pure per share basis, given the dilution and the current debt. This current debt will inhibit future growth as well. Now, total debt reduction and monetization are highlighted by management. They are highlighting deleveraging. It remains a top priority for Sandstorm. I will quote them here. As of February 15th, 2024, the company has $421 million drawn and outstanding on its credit facility to further expedite debt repayment. The company is undergoing a process to monetize between 40 and 100 million of non-core assets by the end of 2024. Accordingly, in the fourth quarter of 2023, Sandstorm closed its previously announced agreement to sell the El Pilar and Blackwater royalties for total consideration of $25 million, comprised of cash and common shares. The company anticipates that consideration from future monetization efforts will consist entirely of cash. So it has gone significantly into debt, now selling assets, which does reduce cash flow in the near term and the future to bring down debt. It's an interesting strategy. Summing this up, the market currently expects Sandstorm to sell less gold in fiscal 2024, produce less EBITDA and less cash flow. So looking at this, current valuations are not compelling, in my opinion. If the gold price does do well in 2024, sentiment will likely help SSL perform well. But as we saw, this is not always the case. We had good pricing environment in terms of gold in 2023, and this company did not perform well at all over the course of the past year. So there was always company specific risks that we have to deal with as well. There are a few other things at play here in terms of SSL. Now they have a mine that's going to be potentially coming online, or a decision made on whether it's going to be built. It's called the Hod Maden mine. Could be a significant royalty or revenue stream for this company. It is primarily conducted by SSR Mining right now. SSR Mining recently had a disaster in its Copper mine in Turkey. There was a landslide. 9 miners were trapped, and SSR on that date lost 50% plus of its share price. So there is some ongoing issues, and the decision on the Hod Maden mine may be delayed even further. So cash flow that could be expected in the future may be delayed. It does look like a mine that could go forward. It just may be delayed as there's some significant problems at the operator. So there's a number of things going on here. But for us, we just look at the cash flow on a per share basis. Great revenue, good revenue growth at this business over the past year. Good EBITDA, but on a per share basis, the free cash flow was actually down.
So yeah. Again, I a couple months ago, I can't remember how long, maybe 3-4 months ago, I did a podcast segment where I looked at all of the gold royalty companies, I believe in Canada and the US.
Mm-hmm.
And so Sandstorm was obviously on that list. And that's one thing that I noticed is that the debt leverage, I mean, the valuation relative to cash flow is much lower compared to the peers. But the debt leverage was quite high. Whereas the others were, very low debt leverage to net cash, right? So it really stood out as being a high debt company, and that's a concern, particularly when other gold streaming companies are not. Always a concern, but when your peers all have these very clean balance sheets, it definitely explained why the valuation on cash flow was lower. Mm-hmm. So it's
And cash on hand for those type of businesses, particularly, if you're not able to use they actually trade on a, cash flow basis, EV to EBITDA lower than some of their peers, but then you don't want to use equity when you're trading at a discount to your peers. And then, they've went significantly into debt relative to peers. So you get in this situation as how do you grow in the future other than the assets you've invested in, to date, which can produce some growth for this company, and they issued a ton of shares to kind of bring that growth on in the future. But now they're in a situation where they're saying we're selling non-core assets, right? So you're bringing down your streaming base by selling those off because you went up significantly in terms of debt, and it just seems like a bit of a catch-22 in terms of where your growth can be going forward. If you tap the equity markets, you're going to be more dilutive than your peers would be tapping the equity markets potentially. And then when if you look to go into more debt, you're going to have a far more debt laden balance sheet like you already do. If you go more into debt, you're going to get farther into debt than your peers. And, you're always judged, against your peers. And if your peers offer less debt, have more cash, can take advantage of market conditions when they come about because they have cash in the bank, it's hard to outperform the segment when you put yourself in that situation. And, some of the streamers I think that have done the best have deployed cash flow from operations more effectively and kind of done it at a slower pace than potentially Sandstorm is trying to do.
Yeah, and we, included Sandstorm as a monitor in our 2022 cash rich report, and then at that time, they did have a cash rich balance sheet. I think at December 31st of 2021, they had about net cash of, I think, around 14 million no debt. They just had leases at that time. But clearly, a different business today.
Yeah, gotten very aggressive, really, in
Mm-hmm.
terms of where they've gone, and the share issuance significant too. So
Yeah.
yeah, that's where you're seeing, adjusted EBITDA higher, but cash flow per share not higher. So I mean, that's what's going to drive the share price over the long term. And if you don't have that, it's not surprising to me to see the share price down over the past year.